In 2011, Disney released the cartoon animation Mars Needs Moms. The movie earned a total of $39.2 million or over 1.7 billion pesos, which is also about 20% of the total money corrupted by PhilHealth. In the perspective of a normal living person, such an amount could already sustain the needs for the rest of his lifetime. However, Disney treated it as one of their losses, especially that they are one of the pioneers in the charming industry of media entertainment. They have allotted a budget of $150 million for the production, only to be hailed as flop by the moviegoers. The situation mentioned is what opens for discussion today. Project analysis and evaluation. Project analysis and evaluation is the process of collecting and analyzing information in order to understand the progress, success, and effectiveness of a project. Let's tackle the technical terms by relating the definition to the current response of government authorities to a pandemic. The projection of the government in order to eliminate the cases is by deploying repetitive measurement such as the use of face shield, implementing a variety of lockdowns and checkpoints. They were positive that implementing the said regulation would end this lockdown by the end of December. It's already more than a year now and we're all still in a lockdown. And the cry of our health workers is a strong evidence that we need to shift to a better plan. From such projection, we have lost a lot of lives at hindi lamang literal, kundi pati figuratively kasi araw-araw din naman nawawalan ng trabaho. With this, ito ang sunk cost natin. For a recap, sunk cost is the amount spent that cannot be recovered or generally irrelevant over this time, and we cannot recover the lives of the deceased. The authorities failed to pay attention to the opportunity cost of the situation. Opportunity cost is the cost of the best alternative available that is foregone or given up. One of the opportunity costs we lost is to decrease the amounts of being in a lockdown if they have banned international travels when they detected the first case in our country. The projected evaluation and action towards the situation do not coincide with the actual result. The analysis and decision become a nuisance to the Filipino people, and with that it relates to forecasting risk. What is forecasting risk? Forecasting risk, also referred to as estimation risk, is the possibility that we will make a bad decision because of errors in the projected cash flow or action. If the projections are seriously in error, merong tinatawag na garbage in, garbage out, which means when you use a material or make a decision that is in poor quality, the result will be in a poor quality as well. In the perspective of business or accounting, madami ang nag-iingganyang mag-invest sa stocks, different businesses at iba pang pwedeng maging sources ng both active and passive income nila dahil sa value ng balik nito. But why is the lot still failed with their ventures? Let's identify what is the net present value. A net present value is the difference between the present value of cash inflow and the present value of cash outflows over a period of time. The NBV relies on the discounted rate, but why does it rely on a discounted rate? Discounted rate can be used in two contexts. One, it is the interest rate for short-term loans, or two, it calculates the current value of the future cash flows. What is its purpose? To help the management identify if the money invested in the present will still be profitable over the following years. That is why it is being included in the capital budgeting and investment planning. We need to be more suspicious when analyzing and evaluating our cash flow. Isa sa mga rason kung bakit hindi pa rin profitable kahit naka-positive ay mali ang naging estimation. It could also be that the management was too confident with their projection that they failed to foresee. From this forecasting risk, it is important to ask questions such as 1. Is our product really better than the competition? 2. Can we manufacture at a lower cost or more effectively? 3. Who is the potential competition? In addition, it is always necessary to think about the potential competition. Potential competitions are when the potential competitors do the same thing that you do and target the same kinds of customers. Due to the potential competitors, it's a merged profit in the volume of demand. In short, they affect the net present value to the positive. That is why having a positive NBV is rare in a highly competitive market. When investigating a new project, it is natural and necessary to be filled with a lot of what-ifs, questions and scenarios. It happened as determined what happens to NBP estimated. This analysis is called scenario analysis. Questions such as what if unit sales should be projected at 127,000 units instead of 120,000 units will help us find a better and realistic alternative to have a positive NBP. There could be hundreds of scenarios to be examined, but the gist to this is to pick for the worst and best case. It is advised to start off with the basic one. The scenario analysis includes the base case, which is the initial set of projections. Best case is the highest or most favorable values. Worst case is the lowest or least favorable values. To be better understand, here's an example. The Telecom Globe launched a new series of internet upgrades, especially for the students and work-from-home employees. They projected a base sale of 10 million units for the month sales. However, despite the upgrade, a new telco competitor launched a cheaper amount for their internet services, which only led to Globe to sold 3 million units within a span of 1 month. The next analysis is called sensitivity analysis. It is useful in pinpointing the areas where forecasting risk is especially severe. To simplify, what will happen to the net present value if one variable is changed? What is its purpose? 1. To know what variable needs more attention. 2. If NPV is sensitive to certain variables. 3. What forecasting error will do the most damage? For example, Mark is in charge of sales for GiftMate, a mall. He knows that the holiday season is approaching and that the mall will be crowded. He wants to find out where an increase in customer traffic at the mall will rise the total sales revenue of Holiday Co, and if so, then by how much. The average price of a packet of Christmas decoration is 500 pesos. During the previous year, holiday season, Holiday Co sold 1,000 packs of Christmas decorations, resulting in total sales of 500,000 pesos. After carrying out a financial sensitivity analysis, determines that a 10% increase in customer traffic at the mall results in a 7% increase in the number of sales. Using this information, he can predict how much money they will generate if customer traffic increases. For simulation analysis, it is a combination of scenario and sensitivity analysis. That is why it needs computer assistance. Break-even analysis is a popular and commonly used tool for analyzing the relationship between sales volume and profitability. There are a variety of different break-even measures, and we have already seen several types. All break-even measures have a similar goal. Ang palaging tanong dito, gaano ba dapat kababa o kapangit ang sales bago natin masabi na nalulugi na tayo? Malaki pa yung posibilidad na hindi magiging maganda ang sales for this month. Una sa lahat, ano ba muna yung fixed and variable cost? Variable cost, ito yung cost na nagbabago kapag nagbago rin ang bilang ng output. For example nito ay ang mga labor. Kunwari, nagsara na ang negosyo dahil sa lockdown due to pandemic. Babawasan ng variable cost dahil hindi na kailangan ng direct labor. The relationship between total variable cost, cost per unit of output, and total quantity of output can be written simply as total variable cost equals to total quantity of output times cost per unit of output. Fixed cost. Ito naman yung cost na hindi nagbabago kahit magbago yung quantity ng output during a particular time period. Example nito ay lease payments at sahod ng mga trabahador, which are fixed for a particular time period at least. Pero hindi rin ito habang buhay na fixed. Tinatawag din sunk cost and fixed cost dahil kahit na anong mangyari, kailangan itong bayaran ng kumpanya. Total cost. For a given level of output are the sum of variable cost and fixed cost. For example, if have variable cost of $6 and fixed cost of $10,000 per year, 6 times 22,000 plus 10 equals to 142,000. Marginal or incremental revenue. It is the change in revenue that occurs when there is a small change in output. The average cost of units in our previous example is 142,000 or 10,000 equals to $14.2. The 8.2 marginal or incremental revenue exceed the 6 variables cost. There, the company should take the order. Accounting break-even. Dito natin malalaman kung kilala ba ang negosyo o malulugi sa project na gusto mong i-propose. Remember, because we are discussing a proposed new project, we do not consider any interest expense in calculating net income or cash flow from the project. Also, notice that we include depreciation in calculating expenses here, even though depreciation is not a cash outflow. That is why we call it an accounting break-even. And finally, notice that when net income is zero, so are pre-tax income, and of course, taxes in accounting terms, our revenues are equal to our costs, so there is no profit to tax. Use for the accounting break-even. Malaking tulong ito sa decision-making and forecasting ng mga managers. For example, nagbabalak ang owner na mag-expand into new markets. Knowing the accounting break-even point will give them idea if the plan will work good enough for the company to grow. Operating cash flow, sales volume, and break-even. The general break-even point is basically derived from the sum of fixed costs plus operating cash flow divided by price per unit less variables cost per units or contribution margin. General break-even quantity. Quantity equals FC plus OCF divided P minus P, where FC total fixed cost, P equals price per unit, B variable cost per unit. The equation price less variables cost is an important equation to compute for the contribution margin. This relation can be used to determine the accounting, cash, and financial break-even points. The accounting break-even point occurs when net income is zero. Operating cash flow is equal to depreciation when net income is zero. So the accounting break-even point is Q equals FC plus D over P minus P. We must also remember that the OCF at the accounting break-even point is the depreciation. There are several reasons on why the accounting break-even is used. It is easy to calculate and it is used to see if the project will reduce the total earnings of the company. If the project breaks even on an accounting basis, it results in a loss in financial sense and opportunity cost sense. Operating cash flow equals the depreciation. It has a negative NPV and a zero return. The cash break-even point occurs when operating flow is zero. The cash break-even point is thus Q equals FC plus 0 over P minus P. A project that always just break even on a cash basis never pays back, has a NPV that is negative and equal to the initial outlay and has an IRR of negative 100%, and it only covers its fixed costs. The financial break-even point occurs when the NPV of the project is zero. The financial break-even point is higher than the accounting break-even point usually. The financial break-even point is Q equals FC plus OCF over P minus P, where OCF is the level of OCD that results in zero NPV. A project that breaks even on a financial basis has a discounted payback equal to its life, a zero NPV and an IRR just equal to the required return. Operating leverage is a financial efficiency ratio used to measure what percentage of total costs are made up of fixed costs and variable costs in an effort to calculate how well a company uses its fixed costs to generate profits. Fixed costs lead the operating leverage, wherein the higher the fixed cost, the higher operating leverage will have. And so, the lower fixed cost, the lower operating leverage will have. Capital intensive is a process that requires large amount of money and other financial resources to produce a good or service. An example of capital intensive production is Cadbury chocolate. A majority of the work completed daily in Cadbury chocolate is done by expensive machinery. This allows you to produce large quantities of products in a very short period of time. Making Cadbury chocolate on mass production allow the business to have large quantities to sell, but they will have to invest in the expensive machinery and also the raw materials to make the good. And labor-intensive is a form of work that needs a large workforce or a large amount to work in the relation to the output. Hotel Chocolate, the specialist chocolate company. This is an example of labor-intensive. Hotel Chocolate is a specialist chocolate company, and to make it even more special, they making it all by hand. Making things by hand is going to take time as you want to get it right. This means they will need to employ more people, which will make hotel chocolate production process labor-intensive. But it gives the customer exactly what they want, a luxury product. Contribution margin is the amount by which your business sales revenue exceeds your variable cost. The degree of leverage is simply the contribution margin divided by operating income. Here are the examples of two income statements which have 2,500 total units sold for income statement 1 and 7,000 total units sold for income statement 2. So, how to compute their respective operating income? Let's start from income statement 1. First, get the total sales by multiplying the selling price per unit, which is 35 pesos to total units sold. 35 times 2,500 equals 87,500 less variable cost. 17 times 2,500 equals 42,500. And from this, we will arrive with 45,000 of contribution margin. Lastly, less or minus fixed cost, 36,000, which already given above. And the answer will be our operating income of 9,000. Income statement 2, do the same procedure and we will get an operating income of 90,000. Next thing to do is to get the degree of leverage for each income statement, and the formula is degree of leverage is equal to contribution margin over operating income. For income statement 1, 45,000 divided by 9,000 is equal to 5 as degree of leverage. And for income statement 2, same formula, 0.4 as degree of leverage. Notice that the degree of operation leverage can be different on the same company because the degree of operating leverage depends on the sales level. Different sales means different degree of leverage. What if there is a scenario on our income statement 1 wherein our total units sold is increased by 20%? So in order to get our new total units sold, simply 1 plus the percentage or 0.2 then multiply to previous units sold, which is 2,500, and the product will be 3,000 units. Do the same procedure to fill up the table. Notice that everything changed in our table except the fixed cost, and our new operating income is 18,000, which is twice as compared to the old operating income. This shows that the increase in production or selling of units affect our operating income. Another way of calculating the changes made is to get the changes in sales and operating income. To compute these factors, we will be using the general formula percentage. Change is equal to new amount, old amount over old amount. Let's begin on changes in sales, which is equals to 105,000 new amount minus 87,500 old amount over 87,500 old amount as well, equals to 17,500 over 87,500, and the final answer will be 0.2 or 20%, which makes sense since our increases total units sold is 20%. They must be both equal. Next, let's try to calculate the percentage change in operating income. Same formula, new minus old over old, and the change in operating income should be equal to 1 or 100%, which also makes sense because 100% on changes means that the value of our operating income should be doubled, which is correct. On our income statement 2, there is another scenario wherein our total units sold is decreased by 45%. To compute the new total units sold, just 1 minus the percentage or 0.45, then multiply to all total units sold. The product should be 3,850 units. Do the same computation to fill out the table, and there are the computation of percentage change in sale, which is equal to negative 45%, and percentage change in operating income, which is equal to negative 63%. So let's check if these answers are correct. To do the checking, here are the methods. First, negative 45%, the change in sales times 1.4, the degree of operating leverage is equal to negative 63%. The changes in operating income, second, negative 63%, the changes in operating income divided by negative 45%, the change in sales is equal to 1.4, the degree of operating leverage. Lastly, negative 63%, the changes in operating income divided by 1.4, the degree of operating leverage is equal to negative 45%, the change in sales. After to do so, we found out that our computation is all correct. On this slide, we will be comparing income statement 1 and income statement 2. Here's another way that the operating leverage commonly looked at is in terms of fixed cost as a percentage of sales. The formula that we'll be using is percentage of fixed costs related to sales is equal to fixed cost over sales and multiply by 100. So, on this scenario, the fixed cost 36,000 divided by sales 8,500 then times 100, which gives us 41.14%, versus on this scenario wherein fixed costs are still 36,000 divided by sales 245,000, which gives us 14.69%. Notice that the higher the percentage or fixed cost relative to sales is the higher the degree of leverage, and the higher the degree of operating leverage is the more sensitive the operating income will be, means that it is most likely to change a lot. Let's say income statement 1 owns by company 1 while income statement 2 owns by company 2, and they are both working in production. To compare, company 1 has lower variables cost but higher percentage of fixed costs related in sales. This means that this company has the ability to produce more units and requires less people to work because of its machinery are required. And it is capital intensive due to its high capital requirement in machinery and raw materials. Company 2 has higher variables costs but lower percentage of fixed costs related in sales. This means that this company has a lot of manpower but produce lesser units, and it is labor intensive because it requires a lot of workers in order to produce its units. And that ends for our discussion today.